Today, we discuss debt traps. That sounds like a made-up clickbait title. Ted's here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, Ted, welcome back. So when I say debt trap, what's the first thing that pops into your mind?
Well, so maybe use a less emotionally laden term, a debt cycle.
A debt cycle.
Which is you've accumulated debt, you can't afford to pay it off, you're just making the interest payments, so you end up borrowing more to make those payments, so now you're in a cycle of borrowing, paying, and it just continues to spiral downwards.
That does sound like a trap to me, too. So, and that's what the cycle is then. So right. Something happens up front. Maybe something doesn't happen. Maybe it's just, I bought a house, I bought a car,
right.
I find it.
Well, something triggers this.
But usually something triggers it. So, okay, I lost my job, I got sick, I got divorced, whatever. I needed to borrow some money to make ends meet.
Right.
And then now I'm paying interest.
Mm-hmm.
So it helped me the month I borrowed.
But
now I've got higher monthly costs going forward because I'm paying the interest.
Well, and the absolute worst example of this, or I guess the best example, but the worst case you can be in, bloody payday loans.
Right? Payday loans.
So you got to have that cash to pay the rent, so you get the payday loan, and next week you got to pay it off, and so now you got to go right back to those buggers and get another one.
I should have had that on my bingo
I know.
card.
I assume it's later in the cards.
It's not. I don't think I had payday loans here. Oh, yeah, I do.
But they're the absolute worst for a debt trap.
Yeah, because you are completely screwed. So even though they've lowered the interest rate on payday loans to $14 on 100 instead of $15 on 100, you're still paying a massive amount. And once you get one, you end up getting three, and you can never get out.
If you don't know exactly how you're going to pay the first one off without, tapping into it again, it's a cycle that repeats itself over and over and over.
And so we talked a little bit about it, but in general, then what causes that? Is it kind of the things I already listed?
Well, so obviously if something goes wrong, this can happen to you. But what's more typical these days is just a high cost of living. So it costs you more to live today than it did yesterday. But I bet your pay hasn't changed.
Right. Or your pay has not gone up as much as inflation has gone up. And of course, we talked about this on our year-end episode. You can go back and listen to that one where we talked about our projections for 2025 and everything. That was like 4 episodes ago, I think. Mm-hmm. And yes, inflation is insidious.
Right.
It's insidious. If your pay goes up the same as your expenses go up, okay, it's fine.
You don't care.
But it never does.
Right.
That's not how it works.
And the timing is never the same, right? Because, again, your expenses can go up overnight. It's almost impossible for your pay to go up overnight.
Yeah, maybe you get an annual raise at the company, but it's been a year of higher expenses that's been...
Or YouTube might have paid you 5 cents
that's
for
right, exactly.
monetizing your videos.
There you go. You never know where the money's coming from. So you borrow to bridge that gap, and now you're into this debt cycle or debt trap. As
robbing Peter to pay Paul. That's another one, right?
That's also good. And your point about the high cost of living. So in the last 4 years, and of course it depends when you're watching the show because there's a new inflation number every month, but roughly the CPI has gone up around 18%, but food and shelter has gone up over 24%. Energy, 33%, so I guess that's like your gas bill, hydro bill, whatever. And gasoline, apparently, is up almost 50%. Now, gasoline bounces up and down and up and down.
But remember, at the start of the pandemic, nobody was going anywhere.
Right.
Gas was down to 85 cents a liter.
Exactly. So it's not surprising that it's much higher than that today.
Right.
So if you are a lower income person
or a fixed income person,
you're spending a significant portion of your income on those necessities.
That's right.
If you're some rich guy, like, I don't know, that guy who makes $1 million a month, he can't pay 100% of his income on necessities because you can only eat so many eggs, right?
Right.
So inflation doesn't affect him as much as it affects that guy at the
other end of the spectrum.
Exactly. Right. And so what's the impact? Well, you mentioned it, payday loans. I get those. But there's other, I guess, debt traps as well that maybe we don't think of as traps. So student loans would be one.
Yeah, the issue with student loans, of course, is that you borrow whatever you need to survive while you're a student. You graduate, you start working. Well, all these debts have now come due. So you weren't making any payments on them because you didn't have to. Now you do. So you've borrowed against your future to get that education.
Yeah, and it's very easy to spend $20,000 a year in post-secondary education. Easy. And I mean, I'm talking about tuition, but also living expense and so on. So if if you're living at home and going to a community college or something, okay, then maybe you're paying tuition and that's it. But if you're going away to a college or a university and you're going to become a nurse or an engineer or something where the tuition is 15 or grand or more a year, and you got to pay for living, 20 grand is easy. So, okay, I graduate from university with $80,000 worth of student loan debt. What kind of job am I getting?
Your whole life is on hold while you deal with that.
Yeah.
So everything gets pushed back 5, 6, 7, whatever years.
And that to me is a trap.
Right.
Unless you graduate as a doctor making $200,000 a year, which is kind of hard with an engineering degree, I'm guessing.
Right.
Then you're kind of in that mess. What about homes? That can be a debt trap, can't it?
Oh, sure. So if you scrimp and save and you buy that house, condo, apartment, whatever the hell it is you bought, suddenly now you have all these maintenance costs and everything else that have to be dealt with. And the insidious one these days is when they raise special assessments because all of the operating expenses have gone up for the condo or townhouse complex. You're the ones who got to pay those.
Well, and in fact, they probably underestimated them to begin with.
Of course they did.
I'm the developer. I want you to buy the unit in the condo. And then as soon as the units are sold, it gets flipped over to the condo corp. And now it's like, well, this is kind of shoddy building.
In other words, it's somebody else's problem.
That's right. We kick the can down the road. So the elevators aren't good. The roof leaks. There's boom. So now you've got way higher expenses. So expenses aren't the debt trap, but the mortgage you've got on the condo obviously is a debt trap.
Right.
And then, of course, emergencies.
Right. So anytime something unexpected happens and it severely causes you to dip into your credit, so you've incurred debt, now you got to have a strategy how to deal with it. Well, you didn't know it was coming along, so you probably don't have a strategy.
Which is kind of the definition of an emergency.
Right.
Didn't know it was coming on. So you can guess that there will be emergencies. My car will probably break down. Well, certainly my car. It's pretty old. But when will it break down? What will the cost be? Who knows?
Right.
So I go out, I borrow money, I get into this debt trap, or debt cycle, as you like to call it.
Mm-hmm.
Wonder which is better for YouTube. We'll have to try 2 different titles for this episode. What happens to your credit score then when you've ratcheted up your debt?
Well, so let's say you don't incur any new credit. You haven't applied for anything new. You're just using the credit that's already available to you. So now your utilization is going way up. And every time your utilization goes up, your credit score goes down. So utilization is how much of my available credit am I actually using?
So not good.
Right. And let's say you actually applied for new credit to do this. So your utilization's already maxed out, so you need new credit to do it. Again, getting new credit normally is a good thing, but as soon as you use it, it's a bad thing. And so you're already in a bad place. It's going to go down again.
Yeah, so there's kind of no scenario I can think of where borrowing more and getting more into the debt cycle is good for your credit score.
Right.
So you're right. When you apply for credit and get more, okay, then I've got more available credit. My utilization goes down. That looks good. But as I'm using it, then I'm in trouble.
Right.
So you and I are accountants. We think of ourselves as CAs, but we're now called CPAs.
That's right.
That's the new thing. And we're also licensed insolvency trustees, a bunch of other things. Let's pretend, though, that we're psychologists. So this next section of the podcast is something we are not qualified to comment on.
Picture you with a little goatee and some round glasses.
That's right. And so I'm going to take notes here. So what is the psychological impact of being in this never-ending debt cycle?
Well, so for most people, the fact that they have debt at all creates a certain amount of stress. And if you're at the point where you're in this cycle or this trap, that stress just gets it's exponentially larger. And it's a type of stress that you can't dispel. You can't send it off by talking to anybody about it because it's always nagging at the back of your mind that I've got debt, no, I've got more debt, and I can't pay the debt, so I've got more debt, and it just gets worse. Yeah,
it's kind of like I'm outside in the winter with no coat on. I can go and talk to my friend about that, but it's still cold and I'm still freezing.
Right.
And it's the same with debt. So, okay, I totally agree with you. When we deal with people every day they tell me, yeah, I'm under a lot of stress. Maybe they don't use those words.
Well, I'm not sleeping. I'm cranky. I'm not concentrating at work. All of those things are the side effects of stress.
And then that impacts the rest of your life. So now.
Right. And everybody else in your life.
Exactly. So your family's not happy with you. You're not fun to be around, but it's not great at work either because I'm distracted. I'm getting the calls from the creditors. The boss is not happy with me, so I'm probably not getting a promotion, probably not getting a raise. Maybe I'm getting fired. That's not good. And obviously it can affect you physically too.
Right.
if you're not sleeping, well, then you're probably going to have, know.
So you get the people that get stressed out that eat more. You get the people that get stressed out that don't eat at all. All of this stuff is just hard on your system.
And what are the chances that this stress leads me to cope by spending more money?
Well, and that's one strategy that people use. You know, you feel instant gratification for getting that new thing that you think you wanted because you saw a TV commercial that told you that you needed it. And then, of course, the buyer's remorse sets in. Well, I had to incur more debt to buy that thing. And it reinforces the cycle.
And that's where the cycle just keeps getting worse and worse. And I totally get it. Like, I'm kind of bummed out. And you know what? That if I bought that thing, I would feel better.
Right.
And unfortunately, I've racked up my debt even higher. And that makes
you don't feel better for long.
Nope. It's like that bag of chocolate chip cookies. Boy, it felt good when it was going down, but it comes
chocolate chip cookies.
Comes that we're going to take a break while we go eat some chocolate chip cookies, which there are some in the lunchroom there.
Right.
So we talked about the financial causes of falling into a debt trap. So you know, I bought a home, I had emergencies, lost my job, whatever. And we talked about the emotional causes of all this and the stresses, but are there other causes, other reasons why someone would get into this debt cycle?
Well, the most obvious one is you just underestimate how much the debt is actually going to cost you. So, you know, when you borrow money, you've got to repay it, but they also charge you interest. So you're paying more than you actually borrowed. You know, think of an example, a car loan where your payment is $400 biweekly. Well, $50,000 car, an 8-year car loan, payment's $400, but what's the total cost of borrowing? That's not something that you think about. Now, it's required by law to be on your contract, so if you read the contract, it's there, but if you're like most of us, you didn't.
And the contract is a whole lot of pages, and I want to get the car, so I'm thinking I'm buying a $50,000 car, it's going to cost $50,000.
And I can afford the payment that the salesman's pitching at you. But the math for that $50,000 car in the example we just gave you is it's over $30,000 in interest. So your $50,000 car is actually costing you $80,000.
Because it's an 8-year loan, so I'm paying 26 payments a year times 8 years. That's a couple hundred payments times $400.
Well, and you're paying biweekly, so you're paying 52.
Yeah, so it's even So
you're right, 26.
26. Yeah, so you're right. I'm paying $80,000 on my $50,000 car. That's $30-some thousand.
Right.
So the solution, I guess, is pretty simple. Read the contract.
Yes, and budget for the actual cost as opposed to what you intuitively think is the cost, because you're wrong.
Yeah, you're right. If I was a salesperson, I would definitely say this is $400.
Right.
That's a small number.
$4 biweekly, you can do that.
Yeah.
We know your paycheck is $2,300 every 2 weeks. $400 is nothing.
Yeah, and look at how much you're paying on buses and how much the cars that you got now is breaking down and all these other things.
Put a reference into our documentary, Debt-Sized.
Debt-Sized. Put a link to the Debt-Sized. Well,
because that explains this whole thing.
And give the 30-second overview of what we explained in that documentary.
So the point that we kind of made with the whole thing is the fact that you're able to incur more debt has just caused everything to get more expensive, because you don't look at the cost of things anymore. You look at the payment.
Yeah. So 50 years ago, when you were just a lad, a house cost, I don't know, $35,000 or whatever it was.
If that. Yep.
And so you didn't need a 30-year mortgage to afford it because you were paying, I don't know, 2 times your annual income for a house or something like that.
Right. Well, and the thought of buying a house that was into 7 digits just was
ridiculous. Yeah,
right?
You couldn't do it. Whereas now it's like, well, yeah, every house you're buying is going to be 10 times your income, because that's just the way it is.
Well, and the car that you bought that first house was $3,000, and now it's $80,000.
Yeah. My first car was $500, but it was it was used, and it was a wonderful 1976 Dodge Aspen. Right. Okay, so let's go to the practical advice section of the podcast then. So we understand that there is this debt cycle. We understand it ends up being a trap that you fall into. So, okay, tell the viewer, tell the listener, what are some ways to avoid. Like, what's your practical advice on this?
So we're going to look at this 2 ways. The first is, how do you avoid the debt trap in the first place? And the second is, once you're into it, how do you deal with it? So avoiding it in the first place. Well, stay away from my most hated object, payday loans, because I can tell you right now, you get that first payday loan, odds are you're going to get a new one in 2 weeks, because you're going to have to pay back the money that you borrowed. And then it's just going to.
And since this is a big, issue with you, you're not a big fan of them. So why are people getting them?
Right. You get them because you can get them 24 hours a day. So the bank's not open and you can easily go online and get this thing. Do it in your underwear, I suppose, if you want to. They're very easy to get approval for. As long as you've got some sort of income stream, they'll give it to you. And so getting it is easy. The hard part is paying it back.
That's why the center camera here only shoots from the table up, so nobody knows what we're wearing or not wearing. So it's easy to get, and I have an urgent need for it.
Right.
So my rent is due on the 1st, but I don't get my paycheck till the 5th because that's how the pay period works.
I need cash.
So I go and get a payday loan to pay my rent. So, okay, what's the solution to not getting a payday loan in that specific case?
Well, in that specific case, you call the landlord and say, look, my paydays are a little out of sync. I'm going to get paid on the 5th. Can I pay you a little late? And maybe they charge you a premium. Probably not, unless you've done this a lot. I think you'll probably be okay, as opposed to paying.
Yeah, and the landlord says, well, I'm going to evict you.
Not in 4 days.
They can't do it in 4 days.
Right.
So you're right. The correct answer in that specific example is exactly what you said. You talk to the landlord and say, look, I can have the money to you on Friday. That's
Work
payday.
A deal. And if you have to, maybe you pay the landlord extra. It's still going to be less than the payday loan.
Yep. And then you have to then avoid that problem next month.
Right. So now I've got to develop a plan to get myself out of this before it becomes a cycle.
Yeah. So in that example, maybe you get paid every 2 weeks.
So now you start paying the rent every 2 weeks.
Right.
Maybe.
So I've got 2 more paydays before the next rent is due. I got to be setting aside money from each payday to cover that. And so my rent is $2,000 a month. If I get a $2,000 payday loan and I pay it off in 2 weeks, what kind of dollars are we talking about here?
$14 on 100, so 20 hundreds. So you're paying $280 in interest for those 2 weeks.
Wow.
Now, if you annualize it, you're going to have a heart attack.
Well, so 14 times 26, I can't do that in my head, but what's that, like 350 or something like that?
Yeah, somewhere in that neighborhood.
So you're people in the comments on YouTube, you can correct us on our math here. But yeah, this is the problem with a payday loan. Even though they've lowered the rates now, because I think originally they were like $18 or $19 on
in Ontario.
If you go back 5 or 10 years, 15 years, something like that. As of January 1st, 2025, they're $14 on 100, but that's still what you just said, $280 if I borrowed a couple of grand for 2 weeks. And if I do that throughout the year, I've paid well over 300% in interest.
Right.
So you have to find a way to avoid that. So, okay, I talked to the landlord and, I work a deal. But my problem is my car is in the shop and it needs a new one of those things, that cars have, that thing that I need to get. And the mechanic says, well, you got to pay me before you get it. Right. What am I supposed to do then?
Well,
I need my car. I got to get to work. I got to come up with $1,000 to pay the mechanic.
And you got to find a way to do it to get your car back. And most of those repair shops actually will have finance contracts you can sign, but it's the same trap. You just got to be careful.
Yeah, but the finance trap is probably not $14 on 100 every.
It'd be much better than a payday loan.
Yeah, and again, I think the answer is you talk to your landlord or you talk to the mechanic and say, "Look, can we work something out?" Or you're right, you gotta explore financing options. You gotta talk to your friends. You gotta talk to your family. Whatever you can do, you want to avoid that payday loan trap. Okay, now you've been yapping about payday loans for 20 years here now. The newest thing, though, over the last 5 years maybe, is buy now, pay later.
So it's the oldest thing that's now
which is
come
actually
back in
the
fashion.
oldest thing.
That's
there you go. So buy now, pay later is available at pretty much everywhere.
Yeah, for the longest time, it was only furniture companies who would do this deal, right? You go in, you'd buy your furniture, you don't have to start making payments for 12 months. And it's interest-free, it's all great. If you don't pay, the interest is retroactive, and you got this big debt you got to deal with. Well, now you can pretty much do it with anything because you can pick payments on your credit card and say, I want to pay these later. I want to do them more installments.
Yeah, so there's a few different ways this works. One is what you just said, on your credit card. And I actually saw it on my credit card statement because I have to pay mine every week. I keep it really low because I don't want to get in trouble. But it did say, hey, this particular purchase is eligible for stretching it out.
For financing.
Yeah, you can pay it over X period of time, with interest, of course. Mm-hmm. The more insidious one is the ones that are offered through the retailers. So you go and you buy your makeup at Sephora, do you, Ted?
I certainly do. That's right.
You get it? I only know that name because when I'm at Union Station walking to get the train, there's this big place.
I have 3 teenage daughters.
You know exactly what I'm talking about then. So apparently you can go on their website to buy that stuff, the makeup stuff you buy, and you can You can buy now, pay later, which means you stretch it out over 6 weeks. So you pay the first third today, and then you pay the next third in 2 weeks and the final third in 2 weeks. Or maybe it's over 8 weeks. Like they're all slightly different. Now, there's no interest, no service charges, no nothing.
Right.
So this is exactly like your furniture example. Back in the old days, you went to, Leon's or the Brick or whatever it was, and you bought the furniture. It cost $1,000. So long as you paid for it within a year, it cost $1,000.
Right.
So there was kind of no reason not to do that. It was free money. You miss a day. Well, now you get, like you said, all the interest is retroactive.
Right.
It's the same with the buy now, pay later. Whether I pay cash or whether I finance it, it's $200.
Right.
So why would I not use buy now, pay later in that particular example?
Well, because if you don't plan for the pay later, you're going to get yourself in trouble.
Right. And also it encourages you to buy more.
Right.
Because, okay, I got $50 in my pocket. I can go buy something for $50, or if the initial payment is $50, I can now buy something for $150 or $200. So you end up buying more, which ends up getting you into trouble later. So, payday loans are kind of obvious in your face if you actually think about it for 10 seconds.
Right.
But the buy now, pay later,
more insidious.
Yeah, exactly. Yep. It's a little more insidious. So, okay, so a couple of obvious debt traps: payday loans, buy now, pay later. What are some of the early warning signs then that you're in this cycle?
Well, the most obvious one is you're having trouble making all your minimum payments, or you're paying the absolute minimum interest and you're not dealing with the debt. And so you're not making any headway on what you owe. If you only make the minimum payment this month, next month you're going to owe just as much money and have to pay it again.
And your credit card statement shows that, right?
Right.
It says if you only make the minimum payments, you're going to be paying
375 years old before you pay this off.
Right. So if you're paying in full every month, okay.
Maybe we don't care.
Yeah, it's, right. And in that case, then the credit card becomes a substitute for cash. You're not borrowing. Fine.
Right. Not an issue.
We're not going to say anything about it. But if you're only paying the minimum or not paying the full balance,
right,
then you're incurring interest charges, and that's just going to carry on for forever.
Well, and we already talked about this. If you're feeling stressed because of your financial situation, i.e. you got more debt than you can deal with, that's definitely a sign that you're in some kind of debt trap.
And yes, if you feel stressed, then you've got a problem.
Right.
And it doesn't matter if we're talking about money or your health or whatever.
Whatever it is.
It's all the same thing. Now, you're old enough to remember that,
hey, speak up.
In the old days, we used to get things in the mail.
Right.
You remember that? And we're not going to talk about the great postal strike of 2024 because that's not the point of this show. But in the old days, your statements would come in the mail.
Right.
Your credit card statements.
And if you were behind, you'd get another letter and another letter.
Right. And so you and I have both experienced this many, many times where someone would come in to meet with us and we'd say, so how much do you owe?
Right.
And they plop all these envelopes on the table.
That they've never opened. And so we would spend the first 5 minutes of the meeting, because you always carry a switchblade with you. It's strapped to your left ankle at all times. We're going through adding them all up. It's a huge number. Now, nobody gets paper anymore. Right. So now you get a text message or an email.
And are those easier to ignore than the paper piling up on your kitchen table?
They appear to be.
Yeah.
Because, delete, whatever.
Yep. And so if you are deleting emails and ignoring them, then I think you are in the debt trap.
Right. You're already in the cycle of going downwards.
You're already in that cycle. So the question for the viewer right now would be, can you off the top of your head tell me how much you owe on each of the things you owe it?
That'd be a good question.
And it's like, well, I know I got my mortgage. I don't know the exact number. I got a car loan. Roughly, okay, that's fine. What about your credit card? Are you behind on your hydro bill, your phone bill, whatever?
Overdrawn, line of credit.
Exactly. And if you don't know the numbers off the top of your head, not to the dollar, but roughly, then yeah, you're probably in the debt cycle.
Right. But the easiest numbers to remember are when there's zeros.
That's right. Right. Then it's I don't know anything. I pay everything in full at the end of the month. Right. Fantastic. So back to practical advice then.
Okay.
So, I want to avoid the debt cycle. Give me, off the top of your head, what are the other things to think about?
So one of the things we said at the outset, the reason that you get into this debt cycle, this debt trap, is because it's costing you more to live than you've got coming in. So the obvious response then is you've got to work on a budget. Now, we know everybody hates that term budget, but the idea is you've got to make sure that you've got more money coming in every month than going out. And so you adjust your expenses so that you get to the point where you've got more money coming in than going out.
And I do hate the term, and I do hate budgeting, even though we're in the process of releasing a budgeting course to go through this. It may already be out by the time you're watching this. I think you have to at least spend a few weeks keeping track of everything you spend, just so you know where you're at.
Well, and that exercise in and of itself will stop you from spending some of that money. If you write down every dollar you have to spend, sometimes you're going to go, why the hell am I spending this?
Yeah, it's like, okay, that's how much I spend at the coffee shop.
Right.
Okay, and just for the viewer, this is probably the first time in the history of the show I actually have coffee in my coffee mug here.
I don't.
Ted's mug, there's nothing in it.
Right.
It's all food.
You don't want me on caffeine.
No, Ted does not do caffeine because he'd be going crazy. So if you can't be disciplined enough to keep track of every single dollar, which most of us can't, then at the very least set your bills up on auto pay so that the money's going out of your account for your hydro and your whatever, so that at the end of payday, well, whatever's left, that's what I can spend. Right. That kind of keeps you reined in.
And don't replace cash with credit cards. You either get one or the other. Don't use both.
That's the trick. So, okay, so I have some kind of system, some kind of budget.
Right.
And then the only way to avoid emergencies that bite me is to have an emergency fund.
Right. So you've got to slowly try to accumulate a relief fund. And you need to pay off your debt first before you start doing this. But your goal should be debt-free, and then I've got some kind of emergency fund.
Yeah, and you decide for yourself what number's appropriate, because I don't know.
1 month, 2 months, what do you need?
Yeah, I mean, if you were to lose your job tomorrow, okay, I guess I apply for EI and it takes this many weeks for it to kick in. If I get fired, maybe I get some kind of termination, so maybe I don't need anything immediately or whatever.
Right.
But that's the math you got to do. How big a break could I have in my income? And therefore, how much do I need to have saved up to cover the rent and buy the groceries and things like that?
Right.
You figure that number out, the emergency fund would be great.
So the stopgap for an emergency fund is to have like a line of credit that you only use if there is an emergency. But remember, once you use that line of credit, now you've got debt that you got to deal with. So we're not encouraging you to do that, but in the absence of any other type of emergency fund, that's much better than overdrafts and payday loans and putting it on a credit card. The interest rate will be better.
Yeah, and the problem with a line of credit is the bank can cancel it anytime they want.
Right. Or raise the interest rates or do whatever.
It's like, right when I need it, we're in the middle of a recession and the bank's decided to cancel them. So it's a solution. But, I mean, other solutions would be to talk to your parents, talk to your brother who's got money. And, hey, look, if I ever get into trouble, could you loan me $500? I don't need it now, but that kind of becomes a little bit of a backstop. We always talk about financial education. This is kind of the whole point of this podcast.
Right.
I don't know if there's anything more to say about that in terms of avoiding the debt cycle other than everything we've already said so far today.
Yeah. The most important thing to be aware of is just how much interest costs, whether or not somebody's paying it to you or more likely you're paying it to them. That's the thing that causes all of this problem. It's interest, the cost of using other people's money.
If there was no interest, I guess we wouldn't need to have this discussion.
And we probably wouldn't have a job.
Probably wouldn't. Exactly. No, we definitely would not. So, and obviously one of the solutions people always think about is, well, I'll get a debt consolidation loan to pay off all my credit cards. Right. The interest rate will be lower. Yeah, but do you qualify?
Well, and they sound great, but if when you do a consolidation loan, you don't actually cancel all of those existing credit cards, all you're doing is doubling down.
Right.
And we see that all the time. You get a consolidation loan from your bank, financial institution, cleans up all the debt, but they don't make you cancel the credit cards. And so 6 months later, you're right, it's worse because now you owe twice the money.
So if you're in the debt cycle and you've got more debt than you can handle, the obvious solution is try to increase your income, cut your expenses, dig your way out.
Right.
That's the best solution because it's going to look best on your credit report and you'll get everything paid off. But if the debt is overwhelming, then that's where we come in. You're probably talking to us about a consumer proposal.
That's right. Consumer proposal is a solution where you repay a part of what you owe. Now, you're probably thinking, why would anybody accept that? Well, it's an alternative to bankruptcy where they probably get next to nothing. So the proposal makes sense if you're feeling all of these problems. So you're only making your minimum payments. You're feeling stressed. You can't talk about it. It's affecting other aspects of your life. Proposal can make all of this manageable. And that's really the goal, to get control back in your life.
Yeah, it's not the correct solution for everybody, but if your debt is overwhelming and you need to get it down to one payment that you can afford, yes, it's going to have a negative impact in the short term on your credit score.
Right.
You're it's going to hamper your ability to borrow in the short term in the future.
Which is a good thing.
But if your minimum payments are $2,000 a month now, and we can do a proposal where you're paying $400 a month.
Well, and the biggest single saver in the proposal is there's no more interest. And so remember what I was just saying. Interest is the thing that gets us all in trouble.
So by avoiding that, we can get you out of the debt cycle or the debt trap.
There you go.
Excellent. Ted, thank you very much. That is our show for today. If you're watching on YouTube or any of the podcast, audio channels, Spotify, Apple, whatever, I will put links in the show notes to Deticized, our documentary that was released last year that explains in much more detail the big picture issues. We'll put links to the other things we've talked about as well, including what a consumer proposal is. A reminder, there is a new show every week, so please like, subscribe, hit the notification bell on YouTube or whatever podcasting platform you are watching. So, until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.